Good afternoon and welcome to a little midday video here for a quick analysis. I'm just getting kind of bored watching the chop here in the markets for now. Not going to go over my previous trades of the last couple of weeks. I've taken quite a few, overtraded a little bit, took some time off, taken a couple of hours here and there to just step away from the markets and get focused. But anyways, just want to touch on this sell-off. Now, we have a huge range that's set up now here, from 294 all the way down to 279, okay? Does that mean we're going to completely fall apart? No. But what I will say is this is absolutely irresponsible and just borderline criminal for CNBC to come out and allow now a second hedge fund manager in Stanley Druckenmiller to come on the air and basically cry, saying that he's afraid of how the U.S. market is going to perform, sad about the state of the economy, all this and that, and it's absolutely blows my mind that they are allowed to do this. I guarantee you he probably had some massive short position, just like Ackman did a few weeks ago, where he made a grip of money on this drop. Now that's just I don't even know how else to say it. It's just criminal. There should be no way in hell they are allowed to go on there knowing they can influence the markets in the way that they do and do this. Now, did I have a long position? Did I get caught in that drop? No, I wasn't in anything significant. I mean, it sucked to see some of my holdings go down, but it's just outright criminal to have someone on there. And if anybody is deserving of an SEC investigation, it's this D-bag and CNBC to be able to do that kind of stuff, because I guarantee some of those talking heads probably capitalized on this drop as well. Okay, so enough of that kind of a rant. So we have a big range that's set up here. This here's the 50 SMA. Let me zoom in here to the daily. It's easier to see what moving averages are what. Actually, it's not on my daily chart, whatever. So somewhat holding near the 21 EMA. This is the yellow line. Price action is still bullish. So it's 8 EMAs above the 21, shows that there's still at least the opportunity to consider this an uptrend that's still in force. And we put in what looks like could be a potential breakout if we do start to rally above this 294. Now, what the robots like to do here with SPY is once they identify a significant turning point, that being the low of here of 279.13, they like to go ahead, dip below it, take out some stops, trick some people into going short for a potential breakdown, only to turn around, flip it, and rip all the way back up. So hopefully that's what's going to happen here. There's a different chart setup than what I normally use. I have an anchored VWAP also on here from 323, which is about, I think it's around here, around 260, 263 somewhere right now. So worst case scenario, if this does break down, maybe that's where we stop again. But one thing I will point out is since the March 23rd low, we've now had 1, 2, and potentially a third higher low leading up to this 295 level for a potential breakout. Now that's just thinking way ahead if that does occur. We have just completed the significant earnings season. At least the major market movers have all reported. They didn't do too bad, although they couldn't really be expected to do too much in a positive manner simply because of things being shut down. So with that said, zoom back out here to the weeks. We're just inside of the prior week. Now, if we do take out this last week's low of the 279.13, that does put in a bearish engulfing week. Does that mean we break down, come all the way down here? I'm not saying it's impossible. I'm just saying, in my opinion, it's unlikely. The only thing I think that would catalyze that kind of a move is some new negative development in the headlines, and that may be in the form of renewed trade tensions with China. There's the investigation going on from multiple countries going on into whether or not they were hiding information from not only the U.S. but the world. So if that does occur, that could be a reason for a sell-off. However, a lot of businesses have already prepared for this, or should have been anyways, and a couple of years, maybe a year and a half ago or so, I mentioned in one of my videos that a lot of major corporations were moving their operations out of China already to avoid the tariffs. I mean, the ultimate goal, at least in my opinion, was to incentivize businesses to bring their manufacturing and bring their companies back to the U.S., generating jobs and whatever the case may be. Some of them did. Some of them chose to go another route and went to other countries where there is cheaper labor and it wouldn't cost them as much as even producing in China. So anyways, again, that's something else for another day. But as of right now, just a large range here set up in the SPYs. I want to go over the different sectors here. I have these sectors in order of weighting on the S&P 500. So first of all, we have technology, which is the Qs. Here on the daily time frame, you can see very bullish. Price was above the 821 right here. 50 was somewhere in the middle, and the 200 SMA. So not in a bad situation overall, in my opinion at least. It did come up here and reject off of this gap, although it did pierce into the gap. So generally speaking, when a stock or an ETF or whatever the case may be has a gap such as this and price action comes up to it, if it tags it, such as even if this day would not have pierced it and it was rejected, then I would consider that gap to be a strong gap. Well, it pierced it, closed above it once, twice, and then eventually rejected and came back down. So for that reason, I don't think this gap is going to hold too much strength. I don't think we're going to come all the way back down here to March 23rd lows of 165. Probably come back down here to another level of demand. Anybody who missed this level, which was probably why Ackman and Druckenmiller and whoever the next dumbass hedge fund manager that's coming on CNBC is going to come in. They probably missed this run up, so they're going to go out there and essentially talk their book and say, "Oh, I'm so sad that things are, not as good as they could be," and blah blah blah, and the market sells off. So that could cause another dip. But anyways, tech has been doing very, very well, even with the earnings report that came out, including quarter number one. Next up we have here is XLV. This is the healthcare ETF. Again, another one that came up here, tested this gap, actually pierced through it, didn't quite hold above it and close above it, but it's still not showing all that much weakness. As you can see here, I zoom in here a little bit on the day. This here was the level at 101.61. Didn't quite close above it, but it did pierce it a couple of times, and naturally a gap should have some supply in it, or demand depending on the direction of the gap. But anyways, now it's just going sideways. So now we have a couple of levels here for consolidation. We'll call it up here to about 102 down to 96. Not too bad of a range to trade against. Below there, significant level with the 200 SMA. So healthcare represents, let's see, I think it's over 10%. Healthcare is 15% of the overall S&P 500. Now that consists of Johnson & Johnson, United Health, Pfizer, Merck, Abbott Labs, AbbVie, and Bristol Myers. Those are just to name a few of the top 10. So healthcare has really benefited from this coronavirus nonsense that's going on. It sucks to say it in such a manner that that's why they're benefiting, but it is what it is. Next up we have, this is the communications ETF. This represents 11% of the S&P 500. Now, that's simply because, in my opinion, the top three holdings are Facebook and Alphabet. So Facebook, Google, and Goog. And as I zoom in here to the actual ETF, that is 20.5% Facebook and roughly 23% between Goog and Google. So of course, if those are your top holdings, this one is going to be performing very well. Rounding out the other top 5 or 6 are T-Mobile, Activision, Netflix, EA, Charter, Disney, and Verizon. Okay, so communication has some powerhouses that are really holding up fairly well, and they're things that everybody uses on a daily basis. So to think that the virus 2020 is going to wipe out any sense of growth or progress in the last couple of years and sustain that kind of move down is just nonsensical to me. So next up we have here is consumer discretionary. This makes up 10% of the overall S&P 500. The major holdings here are Amazon, Home Depot, McDonald's, Nike, Starbucks, Lowe's, and Target. So the major player here, of course, Amazon, is 24.5%. Now, Amazon came out and reported they actually had blowout numbers. However, they're spending a tremendous amount of money on precautionary items for the virus. The question will become, or has become now, is this going to be a recurring cost? I think Bezos said they were going to spend about $4 billion on thermal imaging cameras, thermometers, gloves, masks, geared to PPE, personal protective equipment, whatever they use to keep their workers safe, I'm all for that. That's where their money is going. So the question is going to become after that, does that warrant selling off Amazon? Is it going to be a recurring cost? If it is a recurring cost, that's going to be a significant cut into their actual profits going forward. Now, I believe strongly that as more and more information comes out about this virus, more and more people will see that it's extremely overblown, and we'll be able to get back on with our normal lives and go about things just like it's the flu. So Amazon's still doing well, holding up very well, and that is consumer discretionary. Next up, we have XLF financials. This is actually my favorite sector right now. I am underwater on some leaps here for the XLF calls. I'm also in some individual banks. For whatever reason, banks are not in favor. There's a lot of fear in the market that there's going to be defaults on loans or whatever. Again, this virus is not something that's going to be around forever. This is not 2008. This is not 2009. This is not 2000. So this kind of a move, while I'm not saying it's impossible, it seems like it should be very unlikely to see that kind of a move simply because this is temporary. So XLF makes up just over 10% of the S&P 500. So even though it's showing weakness, at least it's not all the way back down to the March lows. As I said, I'm pretty substantially invested into some individual names and the XLFs going forward. I believe strongly that they're going to come out of this, even if some of the smaller banks, whatever, do need to merge with some bigger ones. It is what it is. I think that Berkshire is actually the heaviest weighted. Berkshire B share is actually almost 14%, followed by JP Morgan, Bank of America, Citi, Wells Fargo, and the S&P Global Index. So Berkshire being the heaviest weighting here in the XLF, and for whatever reason, Uncle Buffett is not putting money to work, and they're not performing very well at all. That's a huge weight on the XLF here. Now, one key level here that I do have is basically this 22 level. So I want to see it get back above there. The monthly chart, much like a lot of the other sectors, is just a double inside month. I mean, there's not a whole lot going on. There's a lot of chop. That's why I'm not day trading any of these banks. I'm simply buying things to hold. So every time I get another, $1 or $1.50 drop, 50-cent drop sometimes, I'm adding to my 2022 calls here in XLF. So these banks are very undervalued. A lot of them are getting back to under 6 PEs, paying very, very good dividends. And hey, it's worth holding for a long term. I mean, they're banks. Even if rates go negative, banks are still going to make money and most likely still pay dividends. So if that changes, I will reevaluate, but banks look very, very good in my opinion. Now, on to the next sector, which is XLI, this is industrials. Now, I'm going to be honest, I had to go and look and see what the actual major holdings of XLI are. And as it turns out, a lot of these names are actually defense names, other than Union Pacific, Honeywell, Lockheed Martin, Raytheon, 3M, Boeing being 3.7% of this ETF. So it's not the number one weight of the XLI, but it's enough of it to really hold it back a little bit here, and it looks a lot like the XLF. So the XLI is actually 7.6% of the overall S&P 500. So with Boeing holding things down and a lot of these other, call them defense names, I guess, a lot of other industrials not really performing as well as they should. As you can see, hit the bottom of this broken trend line, just a line I've drawn on a chart. Other than that, it really just a line on a chart. I mean, some people put a lot of faith into trend lines, but whatever. I have not done a lot of research on the XLI, so I don't know of the valuations, but I could only assume they've come back down to somewhere near investable levels, at least from the 47 to 50 level down here. So anyways, just at a quick glance, did reject off of here. Looks like it's going to have a decent little pullback here. I wouldn't think it comes back much lower than 55. Zoom in here to the daily chart here. Is below a lot of levels, looking just like the XLF. It had a significant level down here as price action rallied hard, slammed down into this 54 level. So this is at least one new higher low, and just been chopping around ever since then. So if it falls below this 58.76, which probably really shouldn't. I would think it holds around this 56, 57 level to put in a higher low. So that is XLI. Next on to XLP. This is the consumer staples ETF, and consumer staples actually make up about 7.25% of the S&P 500. So in this group, we have a lot of big names that most people should be familiar with: Procter & Gamble, Pepsi, Coke, Walmart, Mondelez, Costco, Altria, Philip Morris, Colgate, and Kimberly-Clark round out the top 10, with Procter & Gamble being number one at 16%, followed by Pepsi at 10.5%. So all of these companies are things that people use every day. You brush your teeth, you eat, you shower, you wash things. Everything you use on a day-to-day basis is here in XLP. I mean, even Kroger, Constellation Brands are in the top 20 down here. Monster Beverage is also one. So pretty much every consumable item you use in your daily life is in here. So the question I have to ask in reference to this illness of 2020, does this stop people from doing these things, from using these things, from going to Walmart, from going to Costco? Walmart has been more business they can ever imagine. Costco, the same thing. Kroger, look at their chart. I mean, it's going up to almost 52-week highs probably here in the very near future. A lot of these companies are being used heavily, more so than ever before, simply because people are being at home. Now, this only being 7% of the S&P 500 will manage to actually help stabilize it, even when tech does sell off. Financials should find a foothold here soon. As I said, they're very undervalued, and this actually looks like a nice little bull flag setting up here on the XLP, breaking above, let's call it 58.5. If this week, maybe next week around 58.40, we'll see what happens with that. But a lot of these names, just at a glance, do look good. Down here in the 48 to 50 level, a lot of these individual names were very cheap and very investable, which is the same thing that happened back here in 2018, when businesses get down to such low valuations, they're considered cheap, and participants just eat them up. I mean, same thing happened here, same thing happened here, same thing happened here. Sometimes it takes a week, sometimes it takes a day. I mean, that's the reason that things bounce so hard from a significant level, and then they got overvalued. Same thing with the overall U.S. market, with tech, with financials. Everything was simply overvalued here into the end of 2019, early 2020. Now coronavirus just kind of compounded things and added to the selling. So anyways, XLP doesn't look all that bad. Over here to XLU, this is utilities ETF. One key thing that I like to point out on here is this is the trend that broke here in 2008. And as I just said a few moments ago, I do not believe 2020 is going to be like 2008, simply because the financial crisis was a much bigger animal. Businesses, banks were going out of business. People were literally losing their homes, losing their jobs permanently. Now the key word there is permanently. Everybody who is out of work, well, not everybody, but the vast majority of unemployed right now are temporarily out of work. Once things open up, which they are starting to open up, they will be back to work. Maybe not in the same fashion, maybe not actually going back to an office or whatever the case may be, but they will be getting back to work and getting paid. Now, if you're not going out to work, you're going to be ordering more things to your home, whether it's food, consumables, entertainment, whatever it is, things are going to be consumed again. Simple as that. And the unemployment rate will drop once all this stuff blows over, once this coronavirus nonsense is done and over with, and people can get back to normalcy. The economy was doing extremely well, although the stock market it's actually not the same as the economy, but the stock market was overvalued, and we got a sell-off. Now, it just so happens to be that there was also a virus that went around that caused the world economies to shut down at the same time. So does that justify wiping out 1, 2, 3 years, pretty much 4 years of quote-unquote progress? I keep reiterating that. I keep asking that over and over again, and I always come to the same answer: is no. A virus that causes things to shut down for 3 or 4 months is not justification for wiping out years of appreciation or years of progress in businesses. Okay. Next up we have here is XLE. Now, I know there are some participants that say, oil leads the market. If energy is doing bad, the market's going to do bad. It hasn't been that way for years. We look back here, XLE topped back here in 2014. Ever since then, it's been nothing but down. XLE is mostly oil names. XLE represents, where is it here, 3% of the overall U.S. market. And as I pull up XLE, I can look and see the top holding is Chevron, followed by ExxonMobil, Phillips 66, ConocoPhillips, EOG Resources, Valero, Schlumberger, Williams Companies, KMI, and Marathon Peat. So all of these are oil and gas related names. Oil being a dying industry, in my opinion. We're going away from fossil fuels. If you can't see that, I don't know what to tell you. Demand for oil will continuously go down, and it's shown here on the chart. It's the reason that most oil holdings have been continue to be phased out of the S&P holdings. They're underperforming. It's as simple as that. So you get a chart that looks like this. Thankfully, it's only 3% of the overall U.S. market, because this is absolutely garbage. This is trash. Now, I am in some USO, which was probably a bad decision, but we'll see. I'm going to give it plenty of time going forward, and that's that. So next up we have here is the XLRE. This is the real estate ETF. Now this one is more of a, it's not necessarily a growth industry, so I can't really expect it to be in any kind of an uptrend or downtrend or one way, shape, or form. It's just it's in a huge range. Now last year it broke out, it was a false breakout, and came back in. I think a lot of them, at least that I had on my watch list, did get extremely overvalued. Most of the time, these REITs that are actually in this sector pay out anywhere from 7 to 10% dividends. But up here at highs, I believe a lot of them got down to 3 to 5%. So nobody wants to buy a REIT if you're only paying 3 to 5%. Again, a situation where things are overvalued and you have the impact to the overall world economy. So this comes back down to 26, 27. There's going to be a lot of REITs that are looking very good. A lot of the mall REITs actually probably will look very nice in the near future. Some of them do now, but we'll see what happens with that going forward. Now the top holding here is AMT. That is American Tower. Oddly enough, American Tower has actually been printing damn near all-time highs. Actually did print all-time highs here in April. Now I wonder why. They're installing 5G towers everywhere. Now, there are a lot of conspiracies going around that some of this COVID-19 nonsense has to do with the 5G rollout. Well, if charts can tell us anything, then maybe there's some truth to that. Now, I'm not a huge believer in that, but maybe there might be some truth. I mean, this is not a biotech. This is not something that's working on a vaccine, and this is not a necessity. This is not a business that provides a necessity to justify being at all-time highs. I'll leave it at that and say that's where AMT is the largest holding of the real estate ETF. Okay, so next up on the list we have XME. This is the mining, or excuse me, metals and mining ETF. Now, most of the metals, most of the mining operations are overseas. They're probably done by foreign companies. I don't really know too much about the mining and metals ETF. I do know that it makes up approximately 2.5% of the overall U.S. market. So included in the XME, we have things like Newmont Mining, we have Royal Gold, Hecla Mining, Reliance Steel. A lot of these companies that I've almost never traded. Alcoa being really the only. Alcoa, US Steel, and Steel Dynamics being the only three that I'm really familiar with. But anyways, as you can see, historically, going back to 2008, 2009, these have simply never recovered since the financial crisis. Now, why is that? I honestly have no idea. I don't even have any thoughts on it other than this being such a small sector of the S&P 500, probably the reasons are negligible. So maybe there's some investable ideas in there somewhere. It's not an industry that I actually touch, so it's just going to point out it's a downtrend. Next up and last is the transportation ETF. Now, I'm going to take some time here on the IYT, and I actually have Thinkorswim doesn't have a breakdown of the holdings of IYT. So over here I have ETF channel, which shows the major holdings, railways down to FedEx, trucking companies, and all the other stuff, and of course the airlines. Now the airlines just basic back of the envelope math make up almost 10% of the IYT, the transportation index here. And if I pull up some of these airlines, you can see American Airlines, Delta, UAL, Southwest, JetBlue, Spirit, Allegiant, which just reported. Not one of these airlines looks good. Having been in this game for about 10 years now, I can't even count how many airlines I've seen come and go, whether it's through mergers, taken private because they can't make it on their own, or just straight up filing bankruptcy. Alaska Air, another one right now. I mean, every one of these airlines are weighing heavily on transportation. Now, why do I bring this up? Simply because I'm a believer in Dow theory. So as transports go, so goes the market, basically. So with airlines being only 10%, but I mean it's many businesses actually help to support them as well. But with airlines performing so well, they are a major drag on the transportation index. Just like I believe it was the consumer discretionary or staples, one of the two that broke down and held below their respective trend line. Same thing has happened here with IYT. And if any of the sectors are going to test lows, aside from the mining and I believe it's energy, transportation index is actually most likely to do so, in my opinion. Even though they do have a lot of other good businesses included in the transportation ETF, it's just a tough sector to really be in right now, simply because so much stuff being shut down. I also want to pull up here, UPS here is not doing too bad, but again, it's one of the ones that's closest to this this March low. FedEx is not doing very well either. So just some stuff to keep in mind. If transports continue to roll over and tech continues to sell off like it has done, at least today anyways, and financials don't get their act together, that could actually spell some trouble for the market. Maybe, I don't think we're going to retest the March lows, but maybe we do get another significant dump down to that 260-ish area. Now, again, there is that possibility of another event on the horizon in that there's a new China trade war to come up because of what they've done with the COVID nonsense and basically withholding information from the world. So with all that said, I apologize. This video went a little bit longer than I had anticipated. I hope everybody is doing well. Keep your head up. Things will get better. And we'll see what happens going forward. If you have any questions or comments, please feel free to leave them down below. Have a good week and good luck.